You've probably heard the warning, never withdraw large amounts of cash or the bank will flag you to HMRC. But the real mistake isn't the amount, it's a pattern, and most people have no idea they're creating one. If you've ever taken out £9,500 one week and another £9,500 the next, you may have already triggered something called a suspicious activity report. Banks don't report it to you. They report it quietly, behind the scenes, and the first you hear about it could be a formal letter from HMRC asking to explain your finances. The specific behavior that causes this is called structuring. It's the act of splitting a large sum into smaller amounts to stay below the £10,000 cash reporting threshold. And under the Money Laundering Regulations 2017, it is a criminal offence, even if every penny of that cash is completely legitimate. Now, to be clear, your normal weekly £300 at the cash point is invisible to the system. Taking out £200 for your grandchild's birthday won't raise any flags. The pattern I'm describing is very specific, and in a moment I'll show you exactly where the line sits. But first, if you're a UK pensioner who values your financial privacy and wants to know how to stay on the right side of that line, subscribe now. I make videos specifically for people your age, covering the rules that actually apply to you. Coming up, I'll walk you through what the banking system actually monitors, why the £10,000 threshold creates a trap for ordinary savers, and the simple three-step check that keeps you completely clear of it. Let's start with the number at the centre of this, £10,000. Under the Money Laundering Regulations 2017, banks, building societies, and money service businesses must report any cash transaction above £10,000 to the National Crime Agency. That's the legal threshold. It's not a guideline, it's a requirement. And the moment that report is filed, HMRC can access the information as part of its routine data matching. But here is where most advice gets it wrong. People focus on the £10,000 figure itself, as if staying below it means you're safe. The reality is more complicated and more important to understand. If you deliberately break one large sum into smaller amounts, specifically to stay beneath that threshold, the pattern itself becomes the trigger. You don't need to breach £10,000 in a single transaction. 2 withdrawals of £9,900 within a short window, with no clear separate reason behind each one, can be enough to file a suspicious activity report. The banking software is not looking at the size of the transaction. It's looking at the shape of your behavior. Think of it this way. The bank system is scanning millions of accounts. It can't call every customer and ask why they needed £9,900 on a Tuesday. So it looks for recognizable patterns. And the most recognizable pattern of all is someone who appears to be counting down from £10,000, never quite getting there. That specific behavior has a legal name, structuring. Section 339 of the Money Laundering Regulations 2017 makes it a criminal offence to arrange or structure financial transactions in a way that is designed to avoid a reporting obligation. The law doesn't require proof of bad intent. The pattern is enough. Now, HMRC doesn't just rely on what your bank tells it. The department runs a system called Connect, which cross-references data from banks, building societies, estate agents, the land registry, and your tax returns. According to publicly reported figures, Connect analysed over 1 billion data records in the period covering 2025 to 2026. What that means in practice is that a pattern of withdrawals doesn't sit in isolation. It gets compared against your declared income, your property, your pension payments, and your spending. So if you're a retired person living modestly on state pension and pension credit, and Connect sees a pattern of £9,500 cash withdrawals, even if the total is perfectly legal, it creates a mismatch that the system wants to investigate. Not because you're dishonest, because the pattern doesn't fit the profile. It's worth saying clearly what this is not about. Withdrawing £300 a week for groceries and everyday spending is completely normal. Paying a grandchild £100 cash for their birthday is completely normal. The system is not designed to catch ordinary life. It is designed to catch organized behavior that looks like an attempt to move money in a way that avoids scrutiny. Most people who get caught by this rule are not money launderers. They're ordinary savers who wanted to make a cash purchase, a second-hand car, a home improvement job, and split the payment across 2 or 3 trips to the cash point because it felt safer or more discreet. They had no idea that doing so carried a legal risk. The key insight here is this: a single withdrawal above £10,000 will generate an automatic report, but it can be explained simply. A pattern of sub-£10,000 withdrawals that appear designed to avoid that threshold generates a suspicious activity report, and those are significantly harder to explain after the fact, because the question the bank is now asking isn't, "What did you buy?" It's, "Why did you structure it this way?" And that distinction between a single explainable transaction and a pattern that looks like avoidance is the entire game. So what does this look like in real life? And how do you know whether your own behavior crosses that line? That's exactly what the next section covers. So let's make this practical. Instead of a list of things to avoid, I want to give you a simple 3-layer test you can apply before any significant cash withdrawal. Not to make your life complicated, but to give you a clear way of knowing whether what you're doing is fine or whether it might attract attention. Layer 1 is the amount. Is any single cash withdrawal above £10,000? If yes, your bank will file an automatic report to the National Crime Agency. That's not the end of the world, it's just the procedure, and a legitimate reason sorts it out quickly. If no, move to Layer 2. Layer 2 is the pattern. Are you splitting what is effectively one transaction into multiple smaller amounts specifically to stay below the threshold in Layer 1? This is the structuring question, and it's the one most people miss. The issue isn't whether each individual withdrawal is below £10,000. The issue is whether the sequence of withdrawals looks like deliberate avoidance. If there's no pattern of avoidance, you're fine. If there is, move to Layer 3. Layer 3 is documentation. Do you have a record showing what the cash was for? This doesn't need to be a formal receipt. A handwritten note in a diary, the date, the amount, the purpose, is often entirely sufficient. If you can show that the money went to a builder, a family member, a specific purchase, you have a clear explanation. And a clear explanation is what separates a normal inquiry from a prolonged investigation. Let me show you how this plays out in 2 real-life scenarios. Scenario A, you withdraw £300 every week over the course of a year. That's around £15,600 in total. There's no single large transaction. There's no pattern of structuring. The withdrawals look exactly like what they are: ordinary living expenses. Layer 1 passes, Layer 2 passes. Layer 3 is not even needed because no flag has been raised. Scenario B, you need £15,000 to pay a builder for some work on your home. You take out £9,900 on a Monday and £5,100 on a Wednesday. The amounts are below £10,000. But the timing and proximity of the 2 withdrawals, made within days of each other, each approaching the threshold, creates a recognizable pattern. The bank's system may well file a suspicious activity report. And when HMRC asks about it, "I needed the cash for a builder," is an answer that should have been accompanied by a receipt before the money changed hands. I don't know every detail of your situation. Maybe you're downsizing and need cash quickly. Maybe you're helping a child with a deposit. The 3-layer test isn't about judging your reasons. It's about recognizing that the system can't see your reasons, only your behavior. So the burden is on you to manage how that behavior looks. What the test does is separate ordinary life from potentially ambiguous patterns. And once you've applied it a couple of times, it becomes second nature. You'll know instinctively which transactions are entirely invisible to the system, which ones will generate a routine report with a straightforward explanation, and which ones to approach differently. Now, at this point you might be wondering, does any of this affect your benefits? If you're on pension credit or you receive attendance allowance, are the same rules applying to you through the DWP? That's a completely separate question, and it's one that causes a lot of unnecessary worry. Let's clear it up. Let me say something that I suspect you already feel, but might not have said out loud. You've worked for 40 years. You've paid your taxes, your national insurance, your council tax bills. You've done everything right. And now, in retirement, you're being told that taking money out of your own bank account could trigger a government investigation. That feels wrong. More than that, it feels deeply unfair. And you know what? That feeling is not unreasonable. It's completely human. The instinct, when something feels intrusive, is to push back, to carry on as you were, simply because you know your own intentions are honest. It's my money. I'm not doing anything wrong. Why should I have to justify myself to anyone? I've heard that exact sentiment from people I've worked with, and I understand it completely. But here's where that instinct leads, in practice. I've seen clients who held that position, people who were entirely legitimate in what they were doing, and one received a formal letter from HMRC that took 6 months and £2,000 in accountant fees to fully resolve. Not because they had done anything wrong, because the pattern of transactions looked like something the system was designed to investigate, and by the time the letter arrived, there was no clean paper trail to explain it with. The system is not personal, but it is thorough. So the cognitive shift I'd encourage is a small one. Don't think of the monitoring as an attack on your integrity. Think of it as a speed camera on a road you drive every day. The speed limit doesn't imply that you're a reckless driver. It's just a threshold the system applies uniformly to everyone. What matters is knowing where the camera is, so you're not accidentally triggering it when you had no intention of speeding. The practical version of this is one simple question you ask yourself before any large cash withdrawal. Does this transaction, on its own or alongside recent ones, look like I'm deliberately trying to stay below £10,000? If the honest answer is no, if you have a clear purpose and the transactions are genuinely separate, you have nothing to worry about. If the honest answer is well, maybe. That's the moment to pause, consolidate, and document. That's not compliance. That's just being sensible about how the system works. And there's one more thing worth mentioning. The DWP operates its own monitoring for benefits recipients, but the rules there are specifically focused on universal credit, pension credit, and employment and support allowance. If you're on the state pension and receiving attendance allowance, you are not subject to the same bank monitoring rules that apply to means-tested benefits. The two systems are separate, and confusing them causes a lot of unnecessary anxiety. We've looked at what triggers the system, why the instinct to resist it can backfire, and how to separate the rules that apply to your benefits from the ones that apply to your bank. Now let's get specific, because knowing the problem is one thing, and having a clear set of steps to handle it is another. Right, 3 steps. These aren't complicated, and they don't require you to change how you live. They just require you to be a bit more deliberate about how you handle larger amounts of cash. Step 1. Keep a simple cash diary. This doesn't need to be anything formal. A small notebook, a notes app on your phone, a page in a kitchen drawer, whatever works for you. Each time you withdraw cash above, say, £500, write down the date, the amount, and what it was for. If it's a gift to a family member, note the name and the occasion. If it's a payment for work done on the house, note what the job was. You're not submitting this to anyone. This is purely for your own protection, so that if you ever receive an inquiry letter, you have a contemporaneous record showing where the money went. HMRC can ask questions about transactions going back years, and memory alone isn't always reliable. A handwritten diary from the time the withdrawal happened carries genuine evidential weight. Step 2. Consolidate large withdrawals into a single transaction. This is the most direct way to sidestep the structuring problem. If you need £15,000 for a specific purpose, a significant home repair, helping a child with a purchase, take it out in one go rather than across several trips to the cash point. Yes, the bank will ask you about it. They're required to for any withdrawal above £10,000. That conversation takes a couple of minutes. You explain the purpose, calmly, clearly, without drama, and the bank notes the reason. A single large withdrawal with a stated reason is far easier for the system to classify as legitimate than a pattern of near-threshold amounts with no obvious explanation attached. The math here is worth being clear on. One withdrawal of £15,000 documented at the point of transaction creates a clean record. Two withdrawals of £9,900 and £5,100 made within days of each other create ambiguity. Same money, very different picture. Step 3. Use electronic transfers for gifts and larger payments where you can. For amounts above £250, a bank transfer creates an automatic audit trail. The date, the recipient, the reference. You don't need to write anything down separately because the bank has already done it. This is especially useful for family gifts where the amounts are meaningful. Now, the outline in real life has friction, and I want to address it directly. What if the tradesman only accepts cash? This is a real situation, and it's not unusual for people your age to be dealing with tradespeople who prefer it. My suggestion here is to request a receipt or a simple invoice, even a basic one. If the job is legitimate, most tradespeople are happy to provide one. If they're not, if they refuse any kind of paper trail, that's useful information about how to approach the next job. What about the annual gift exemptions? The inheritance tax rules allow you to give away up to £3,000 per tax year without any inheritance tax implications. On top of that, there's a separate small gifts exemption. You can give up to £250 per person per year to any number of individuals, and those gifts are also fully exempt. The key word is per person. This isn't a cumulative total. You can give £250 to each of your grandchildren. These are well-established rules, and cash gifts within these limits, noted in your diary, are entirely clean. You know the feeling of standing at the post office counter, counting out 20s to hand your granddaughter for her birthday. That's normal. That's a good thing. Nothing about this system is designed to stop you from doing that. What it is designed to catch is a pattern that no ordinary grandparent would ever accidentally fall into. And now you know exactly what that pattern looks like. So you have the test, you have the steps. Let's bring it together. Let's pull it together. There is one bank mistake that triggers an HMRC investigation. Not withdrawing large amounts, but splitting a large sum into smaller pieces in a way that looks like you're deliberately trying to stay below the £10,000 reporting threshold. That behaviour has a legal name. It's called structuring, and it's what the system is built to detect. The 3-layer test gives you the check, the amount, the pattern, and the documentation. Run through those 3 layers before any significant cash transaction, and you will know, clearly, without anxiety, whether you're in safe territory or whether you need to handle things differently. If you want to retire knowing your bank account won't become a source of worry, subscribe now. I make videos for UK pensioners who want to use their money, their own money, earned over a lifetime, without fear of a knock on the door they didn't deserve. The system is not out to get honest people, but it is designed to catch patterns that look like avoidance. By understanding structuring, what it is, what it isn't, and how it differs from ordinary everyday cash use, you can carry on with your life, make the withdrawals you need to make, and sleep soundly. You've earned that. You deserve to enjoy it safely.